Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are on Friday. It's been fascinating markets, but you know how from time to time I like to collect headlines, and you just sort of pick one out that is, well, spectacular. And the one I had this week was the U.S. stock market can't stop, won't stop its endless rally. I mean, this is really quite something, and it reminded me of, bull markets about 20 years ago, and there was also those jokes that were going around. So we crafted one as the question is, how many bulls does it take to change a light bulb? Well, none, because light bulbs never burn out. And neither do bull markets. So this is top of the market type of thing. On the other hand, you've got disturbances still going on in the financial markets in Turkey. And also I saw that the Swedish krona had softened quite a bit. And a few months ago you had problems in Argentina. And these are important because in a great financial boom, it's a global thing. And what typically happens is that the lesser countries, or let's say outlying countries from the financial center, everything gets more precarious there than it does in the main economy. So they're the first to run into trouble. And you've got this back to 2,000 years ago when he was a great writer, Cicero, and he observed that then, 2,000 years ago, if there was a financial problem in the outlying provinces, he used the term provinces, meaning if there was a financial problem in Phoenicia, in the Middle East, that financial distress would then eventually hit the financial center in Rome, which it did do. And there were tremendous financial distresses, mind you. The main instruments were loans and mortgages and stuff like that, but you've got an ancient history of financial distresses being first discovered in outlying regions and then working their way into the financial capital. And that was the case in 1997 when they had the Asian crisis, and it started, July 1st, that year in Thailand, and all of a sudden their currency, the baht, had a problem heading down. Their central bank had run out of their main reserve, which was dollars, and then the advice was in the financial media, it's just a brief problem in Thailand. And then a few weeks later it was in Philippines, and this time the story changed that it could be contained and it wouldn't spread further. And so that started in July, and in September it hit New York, and the month of September then had one of the worst bond hits in the corporate market in a long time. So let's not ignore reality on these things. So it's a fun market. It's had some nervousness in the week because some negotiating deals on trade with China seem to stall out, and there's there's also, Jim, talk of protectionism and tariffs and all that sort of stuff. But what I see Trump doing is kind of rebalancing the equation. Many of those trade deals were done by bureaucrats in China, in this case, and bureaucrats in the United States. And the American bureaucrats were feeling quite expansive and, well, we'll give the Chinese economy a hand. So they had a too much advantage on whatever trade deals there were. The same thing has happened with NAFTA, with Canada, the U.S., and Mexico, where that was put together by bureaucrats, for bureaucrats, and they left out the cheat. And of course, the cheat was that peso depreciated relative to the U.S., which gives that Mexico a tremendous advantage on wage costs. And then, of course, there are times when the Canadian dollar went down to 63 and it was referred to as the northern peso. So they had this trade agreement that was built in to disaffect the United States. But even then, with the new trade agreement, I doubt that there'll be any protection for the United States in that way. But, yeah, U.S. and Canada, huge trading partners. And it should be. If Canada wants free trade, just open the doors, declare free trade in every direction, but make sure with the U.S. that the currency is pegged to the American currency, and then it'll work a whole lot better. So this hit the markets this week. And, of course, since the hit in the stock market was crude oil market was so oversold at Christmas time, you, of course, remember we figured it would rally out to March, April sometime. But the story through the piece was there was always something positive about the agreements and trade deals with China, and then all of a sudden, sort of a week and a half ago, things began to change. So the stock market was overbought and due for a correction. And this is where we think we're at now. We've done our work on the old story about sell in May and go away, but there's a certain statistical interesting things going on with this, is that you can often have a hit in May and then a recovery out to September. And we've done the study, and there's statistics and probability, and our listeners should check out this study we've got. But on, just to finish off the protectionism and tariffs deal, is Trump has been correct in trying to rebalance things. But what you have here is we are in a fabulous bubble, and it's a classic one like 1929. And classic bubbles, when they're over, are always followed by long financial contractions. And then in each country, as trade and business slows down, unemployment goes up. And then each set of domestic politicians have a problem. Unemployment at home, and they do the same thing. Then they come in with protectionism, and it goes way back. I mean, I've got evidence back again in Roman times where protectionism was brought in, but the one I like best is with the 1825 bubble, which was a huge one. And when it crashed, the hardships in America were severe. And so they came in with protectionism to protect, a developing industry in the East Coast. And it was so bad that it was called the Tariff of Abominations. And it was. So, what Trump's been doing is correct. But if we go into a bear market, and if we go into a post-bubble contraction, then there would be, they just can't help do it, but each country would then go to protectionism. It won't be a pretty sight.
does this protectionism actually do what it's designed to do, or does it just make the situation worse?
No, in a contraction, unemployment is unfortunately the way things work. So no, they actually make the contraction worse. But it's a knee-jerk thing that governments are compelled to try protectionism in a post-bubble contraction, and it's very sad. But my guess is it will happen again.
Right, the two jobs where you don't need a license or training, a parent or a politician, and both can do a lot of damage with their ignorance.
Oh yeah.
We'll have more with Bob Hoye right after this.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, with Bloomberg saying, well, the markets are so hot right now, you can't stop them. What's that going to do to the U.S. dollar and other currencies?
Yeah, the U.S. dollar has been firm. And just yesterday I sort of looked at the sentiment numbers on it, and it's quite high. And then, of course, going the other way, the euro is on the low side. So this is where we think that where people have been scared this week by the hit in the market, I think this is brief and you can get some stability. And of course, it's always helpful for assets to have the U.S. dollar, asset prices, we have the U.S. dollar going down. So I think a correction in the U.S. dollar, stock market sort of stabilizes in here and maybe has a run out till June sometime. But once again, we got to go back to what we did last summer when the sunshine, remember we used that term, in the financial markets would run maybe to mid-year, and then somewhere after mid-year, perhaps in August, it would turn to the twilight, and then in the fall, with a possible liquidity crisis, that would be into the scary twilight zone. And when I look at it, Jim, these seasonal forces are remarkable, and you can see them in history going way back, like even one of the earliest and very well documented financial crises occurred in the northern cities in Italy and Florence in 1340s. And the major disasters and panics in that problem was in the fall. So here's where you've gone back to our things now. So if through the summer you've got overbought conditions in the stock market, which we have had from time to time, or overbought conditions in credit spreads or the curves, things like that, or various industrial commodities, then you have to look at the seasonals on those things. And this is what worked for us last year, because you remember the huge bubble in lumber. Absolutely fantastic. And it gave all of our huge technical signals, sell signals. And we then started discussing that typically lumber has a low in around October. So I think the price got up to $650, and it was about $310 when it bottomed in October. And then it dithered around, and then we had a good rally early in the year, and then now lumber's back, back to those lows again. So it's a good combination to have a good grasp on seasonal forces, and as well to be able to measure the enthusiasms out there on the way up. And then, of course, you always got to have a measure on the dismal side of it, too, such as at Christmas time, when on our work, the problems, then the liquidity problem, was likely to occur and then maybe clear as late as Christmas, which it did. So our December 26th piece we put out that both the S&P and crude oil were very oversold, and we had technical buys on them. So and then also some of our methods, Jim, we have what we call the downside capitulation, which is designed to, and it works off of momentum and time factors, and you know what it's like in a sharply declining market. The saying is, it's like trying to catch a falling knife, and this helps identify opportunities in dismal markets. And then on the upside, we've got it works the other opposite way, that you get upside exhaustions when a play is overly speculated in. So then that's one method based on sort of momentum and time and stuff like that. There's about 6 parameters in it. And then that's our proprietary work. And then there's another model that we use, which at the bottom gives what we call a sequential buy. And that sequential buy is based upon a pattern, not momentum. So you've got 2 methods. So then when like at Christmas time, when you've got downside capitulations plus a sequential buy, it gives you good confidence on the probability of getting a very good trade out of the deal, which we have. So this is what we're looking for now, would be further development on our upside exhaustion, the momentum thing, and then further development on the sequential sell. And if you get it at the right time and everything else, then it makes for decision making with some confidence, and you can make the right position. So, you know, Jim, I love being in this business.
We'll have more with Bob Hoye right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, there's a controversial ad campaign on right now where a certain company is urging people to get rid of their dinosaur gold, which is heavy and clunky and hard to be mobile with. And then you have Bitcoin, which is light and airy and modern and moves a lot. So dump your gold and use the funds to buy Bitcoin. Would you do that?
Well, always have a little gold for kind of like insurance, and also, if things really go to hell in Canada, you'd want to have some gold so you can bribe the border guards in order to get out. But that's a very old saying. Gold has its place in a portfolio, and gold shares we prefer because you can get bigger bang for your dollar out of gold shares. And we're looking for gold real price it's been building a base for a year and a half here now. And when it breaks out to the upside, then the real price is gold divided by the consumer price index, and when it goes up, the miners make more money, and we can have a lengthy bull market in gold. But that's ahead of us. And then the other one with the Bitcoin thing, we actually a week or so ago got a buy on that sector with our tools that I told you about, and then also on that one, right at the height, it was December 19th, 2018, when we got one of those sequential sells. And that action in Bitcoin itself had some terrific swings, but we hadn't had a signal on that one in 2 years, so we figured, hey, this could be a very important top. And the hit, of course, it turned out to be a disaster, but now it's basing. Then the other thing we use on the Bitcoin is look at like the collapse of gold itself after that huge speculative peak in 1980. There was a certain pattern to the unwinding of the whole speculation, and that works out on any other speculation you want to look at. When they're a real big one, the energy is incredible, and also so is the unwinding. But as it was just timely here, Jim, last week, it looks like the Bitcoin itself is developing a bottom from which at least an intermediate rally would follow. The other thing is that somebody, I think, people are attempting to put Bitcoin, blockchain, and gold and some sort of a senior currency together, which I think will happen because the notion of a national currency, such as a Canadian dollar or the British pound, that is not convertible into gold, has been a disaster for the public. And, of course, the only reason why you have it, a currency that can be depreciated, is that the government use it to transfer wealth and earnings from the private sector into the government sector. So, and it's always been an evil that's been practiced for thousands of years. So, the statists, interventionist economists, say that they have to have a currency that is not convertible because they need a flexible currency, and then they can manage the economy, and then they can prevent recessions. Well, this story goes back to the formation of the Federal Reserve in 1913, and the notion was that if you prevented financial setback that preceded a recession, then you wouldn't have any recessions. And that has been the theory. And then in the 1960s, when macroeconomists got their hands on mainframe computers, they really thought they had it, and then they had their computer thing, and they could then manage the economy, and there'd be no recessions. Well, since the Fed opened its doors in 1914, there's been 18 recessions. So anybody with any common sense would look at it and say, hey, the theory doesn't work. So, but you understand that the central bank's job, the Bank of Canada, or the Federal Reserve in the U.S., it has been corrupted to funding, providing unlimited funding to yet another experiment in unlimited government. And without a gold standard, this has been permitted. With a gold standard, they can't do it. So somehow the public in this popular uprising, which is an attempt to regain popular control of government rather than control by experts, part of it will eventually be a sound currency, one that cannot be abused by ambitious governments. And I think somehow it'll be this blockchain, Bitcoin, gold backing thing, and you're going to end up with a sound currency that will be popularly created and popularly used. And how long it takes, I haven't a clue, because, Jim, I'm not a technician on these things. You just want to look at the bigger picture.
Another wrench that could be thrown into the works, China passed a law banning the mining of Bitcoin that went into effect on May 7th. Of course, everybody says the question with China is they have thousands of laws, but will they enforce them? So will they enforce this one, or will it just be on people they don't like?
Oh, yeah, people they don't like, that's the way it works. But the society, the economy, business, trade, household, people, everything will eventually demand a sound currency that cannot be manipulated by bureaucrats and politicians for their advantage. And the main thing on a gold-backed currency throughout all of history has been is that it limits the ability of governments to abuse their citizens. So I'm all for a sound currency, and the public will eventually demand it, and they'll get it. So, as I like to say, Jim, it's a marvelous time to be vertical and alert with all of these things going on in the financial markets and also in the political markets. It's fabulous time for watchers and actually participators. Everybody should be out there letting their politicians know that, hey, stop the term I use is in your face and in your wallet government, and just say no to them and keep hammering them and protest everywhere you can against taxation and any other abuse the state may be dreaming up.
Bob, always fascinating to chat with you.
Well, we are in a fascinating time in financial and political history, and we can review some of this again on next show or the show after, whenever. And look forward to talking next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.